Hello, everybody. It's Tyler and Socrates from Lucid Investment Strategies. Today, we thought we would get into a discussion. We've got several charts to pull up, but basically a discussion of arbitrage. What is it? We've used the terminology a lot. A lot of people do. Some people use it incorrectly relative to the way Wall Street looks at it, or the commodity traders or the option traders. Each one of those are different, but the basics are the same. And so we'll give you some definitions of arbitrage. What we want to do, though, is apply it to the crypto market. A lot of ways of doing it in this new asset class, and many of them quite a bit different than the traditional sense of arbitrage. Socrates is with us today and is a bit of an expert in various arbitrage situations that are presented in the crypto market. We're also going to talk about GBTC versus Bitcoin and the talk of a premium, because that's really the essence of arbitrage, where you can find a premium or a discount between two securities. But for now, let me say hello to Socrates, have him say hello to all of you, and then we'll get started. Socrates, what's up today?
How's it going? I'm happy to be here as always, and very excited about today's episode. I think that there are some very unique opportunities in crypto as it relates to arbitraging. There are significant spreads at some times. There will be very wildly different prices for crypto based on different exchanges at certain times. And there are also some more traditional ways to capitalize on arbitrage opportunities through the futures on BitMEX. So I think that today's episode will have a lot for everyone to digest, and will basically be a good time to start thinking about these opportunities, because as the volatility picks up, that is when they will become more prevalent. So I'll be very happy to discuss what I have experienced with in the crypto markets, and we'll be very excited to hear about what you've got for us in regards to the GBTC premium.
Terrific. That sounds great. We'll get started just with a dictionary definition of arbitrage, just to clear up all of the murkiness around it. It's very, very simple stuff. But the term arbitrage can be a noun and it can be a verb. And a verb simply means using the noun. The noun itself, arbitrage, is defined as the simultaneous buying and selling of securities, currency, or commodities in different markets or in derivative forms in order to take advantage of differing prices for the same asset. That's the definition of arbitrage. If you buy Apple stock, you're not arbitraging. If you buy Apple stock and you sell Google stock because of a relationship that you found between the two, that's arbitraging. If you buy corn and you sell wheat, that's an arbitrage situation. If you buy a stock and you buy a put on 100 shares of that stock, that's an arbitrage depending on how many shares of the stock you have. In the crypto market, if you buy GBTC at a premium of 30%, it's 31% approximately right now. If you buy it at a premium of 31% over the intrinsic value of the Bitcoin, you don't really care where the price of Bitcoin goes, if it can go up or down. What you're interested in is what the premium does. Does it go up or down? If the premium goes up after you've bought GBTC, you're going to make money regardless of what happens to Bitcoin. If the price of Bitcoin goes down and the premium stays the same on GBTC, you will make the difference between the two of them. And we'll take a close look at that. But so that's the noun. That's all it means. The verb means using that noun to do something. So if you, the verb means buying and selling assets using arbitrage. And here's a very simple quote. Much of the short selling was being done by people who were arbitraging between the bond and the equity market. That's one of the most common forms of arbitrage. That if you buy $1 million worth of stocks and you buy $1 million worth of bonds at the same time, your $2 million portfolio will not go up as much as the stock market goes up. It will go up if the stock market goes up, but only 50% of your portfolio will do that. The other 50% will be influenced by the bond market, which has a yield usually greater than the stock market. And therefore, you're going to be collecting money on the other half of your portfolio. The only question is how much and for how long. All of that is basic arbitrage. And it can get very complicated with all kinds of option strategies. If you watch the Nigerian brothers on CNBC, you'll see all kinds of things that they do where they will buy puts and they will sell calls, and they will be able to tell before the fact of price change what their potential gain and loss is on that particular arbitrage in the option market, and so on and so on and so on. Okay, enough of all that. I'm going to pull up just a couple of very quick examples that we have talked about in many of our vlogs in the past and in some of our webinars. So I am going to do a quick screen share of the one we've been talking about the most recently, which is sector rotation. Sector rotation, by definition, is a type of arbitrage, not in the crypto market, but all the principles remain the same. So if I just pull this up real quickly, what you will look at is a 20-year chart of the various sectors that we talked about in our sector rotation group. And when I talked about it, I said that what happens is things that are at the bottom, for example, utilities in 2012 were only up 1.3%. The way this chart works is for the year 2007, 8, 9, 10, 11, 12 through 18, this is color coded by each of the 11 sectors. So utilities, for example, is in red. And in 2011, the best performing sector for the entire year was utilities. It was up almost 20%, 19.9%. Back in 07 and 08, they were the second best performing, up 19%. And believe it or not, down 29% in 2008. But that still made it the third best sector in 2008. For those of you that remember, that was the beginning of the big downturn where the stock market fell 50% and the NASDAQ fell 80%. Well, if you drop down to the bottom of that year, you see the blue, which is the financials. The worst performing in 2008 was the financials, down 55%. The best performing in 2008 was consumer durables, which were only down 15%, and so on and so on. So when you look at all of the color coding, the idea of sector rotation, notice that the white is the S&P 500 on this chart. And notice that it is always in the middle. Sometimes it goes a little lower than the middle. sometimes slightly higher. But in general, the entire index, which is made up of all those sectors, is going to be influenced by all of those above it, making it go up, and all of those below it, making it go down. So in a year like 2018, where the S&P was down 4.4%, you could have actually had your money in healthcare, which was up 6.5%, utilities up 4%, consumer discretionary up about 1%, and so on. Real estate down 2%. Or if you had your money in energy, materials, industrials, financials, telecommunications, they were all down 12 to 18%. So the spread between the bottom and the top is almost 20% between the top healthcare 6% up and the bottom energy 18% down. Okay. So what you do to arbitrage is if you have half of your money in the S&P 500 and you want to do whatever it does, but you'd like to do a little bit better, you put the other half in those things on a daily, weekly, monthly, quarterly basis that are outperforming the S&P. The tendency is for these things to stay in trends for a pretty long period of time. We saw that utilities for 2 years was up at the top, and 2 years later was up at the top again. But look what happens in between. They drop all the way down to the bottom for 2 years. And then 2 years later, it's at the bottom again. And a year later, it's 3 from the bottom. And 2 years later, it's at the bottom again. In general, looking at these red, you can see 5 of them at the top, in the top 2 or 3. And you see about 6 of them in the bottom 2 or 3 or 4 over a 20-year period. And only 1 right in the middle, right about where the S&P was. So knowing that these things tend to go for a period of time at the top or the bottom gives you plenty of time to reposition a portfolio using arbitrage, where you are lessening the weight of certain things and increasing the weight of other things. And this can be applied across all asset classes, including, of course, the crypto market. Very few people use this kind of a technique in the crypto market, but it should be used at various times. And to demonstrate that, I'm going to stop screen sharing, and we are going to turn this over to Socrates to show a couple of the techniques that he uses and has found in the crypto market. So with that, Socrates.
All right, that was very interesting. I have bookmarked that website. We'll definitely be referring back to that in the future. That's a great way to visualize how the different sectors will move up and down the ladder in terms of performance relative to the S&P 500. So that was great. Thank you for that, and sharing my screen now. All right, so pulling up a website, no affiliation with them. I just think that it is a good resource for identifying arbitrage opportunities within the crypto space. The website is tokenspread.com. Hopefully it doesn't give me any guff here, and we'll load right up. I'll give that a second here. And while that is struggling, we will try something else. Okay, there we go. So tokenspread.com, again, like I said, no affiliation, just find this to be a good resource for identifying arbitrage opportunities within the crypto space. First thing you see here at the top is a chart which illustrates the different price based on different exchanges. So right now we're seeing 92.70 on Kraken, 92.91 on Gemini. We've got CEX, Coinbase, Bitfinex, a handful of others. We see one down here, which is way outside of this band of what would be what I'd consider fair market value. So that could be indicating a potential arbitrage opportunity. This website is Exmo. That's an exchange I have absolutely no experience with. I would very much hesitate to do anything with them just based on this chart here. Anytime there is a significant premium or discount for one exchange compared to all these others, that indicates to me that there's probably something wrong, and I wouldn't really want to be getting my money tied up in there. Sometimes they will be restricting withdrawals for a certain amount of time, and maybe there's very low withdrawal limits. You can only withdraw very small portions per day. So anytime I'm looking at an arbitrage opportunity, I want to make sure that I can get my money out of there as soon as possible. And if I'm seeing any significant divergence, then I'm going to be very suspicious about what is going on here. And I'm going to do some diligence. And if it turns out that I'm comfortable taking a risk here with maybe depositing some money to buy on Exmo, transferring it over to Gemini to sell, I know I can get it off of Gemini real quick if there are no withdrawal limits with Exmo. Everything seems to be going smooth. Then I may go ahead and look at trying to capitalize on this spread. So something to consider is the difference between USD exchanges and Tether exchanges. Often there will be a premium or a discount on a Tether exchange that will be justified by the premium or discount in the USDT USD pair. That is a pair that's offered on Kraken, and it will trade above or below $1. It's pretty uncommon that it stays right at $1 all the time. So if it is above $1, that is indicative. That indicates a premium on the USDT exchanges, because think about. Excuse me, I said that the wrong way. I'm sorry. If the USDT USD premium is above $1, then the price of crypto on USDT exchanges should also be above $1. So if there is what looks like a 3% discount, say, let's just use easy numbers, that on Kraken it's at 10,000 and on Binance it's at 10,300. Well, that may jump out at you as a potential arbitrage opportunity where you can buy for 10,000 on Coinbase and sell on Binance for 10,300 and capitalize on a 3% premium. That's something to be very, very careful about, because generally the premium in the USDT or Tether will completely wipe out any sort of gain there. So if you capitalize on that premium, but now you're sitting in Tether, now you own USDT, you don't own USD, now you've got to convert that USDT back to USD to be able to actually capitalize on the profit. And when you do that, when you convert back to USD, that will generally wipe out all of the arbitrage opportunity that you capitalized on by buying on the USD exchange and sending it to the USDT exchange. So you always want to be comparing exchanges that are dealing in the same pair. And one thing that can be very misleading is the Bitfinex pair is always listed as BTC USD. And they might now be offering both BTC USD and BTC USDT. That might be an explanation, but the last that I was aware, this has always been a USDT pair on Bitfinex. They deal in Tether, they own Tether, and it will on TradingView be listed as USD. So be very careful with Bitfinex. Everything else should be accurate as far as I can tell. So we're looking at Gemini, BitMEX, Bitstamp, Kraken, Coinbase as our USD exchanges, and looking for any premiums or discounts within here that may allow us to arbitrage. So let's see, right now on Kraken, it's 92.71, and on CEX, it is 92.80. So that is a small difference there of $9. We will take a look at the percentage of difference now. That's changed just in the last couple seconds there. So right now we have got Kraken is down here, and there is not much. Okay, so Coinbase is $15 difference. Let's do 15 divided by 92.40. So that is a 0.16% premium between Coinbase and Kraken. Both are USD pairs, and both are exchanges I feel comfortable with their withdrawing procedures, and I would feel comfortable dealing with either of those exchanges on a short-term basis. When you're arbitraging, you're in and you're out, and then you're back out of there. So there we would see a 0.16% premium. And we may think that that's a potential place to arbitrage, buy on the cheaper exchange and sell on the more expensive exchange. Most probably are intuitive in understanding that that probably isn't enough of a premium to make up the difference in fees. And you're exactly right if that's what you're thinking. You've got to think about the fees to buy on the first exchange. You're going to be looking at about a 0.1% fee, 0.15% fee on average to buy. And then you're going to have to withdraw. So now you're withdrawing from the exchange. You're going to have to pay a network fee to transfer your Bitcoin. So that's another fee, depending on how clogged up the mempool is, will determine how much you will pay there. So you won't always know exactly beforehand. So you want to be a little careful and always estimate conservatively. So we've got the fee to buy, the fee to send, and then the fee to sell. So I would think that on average, we're looking at something like a 0.5% fee. If the spread between the exchanges is less than 1%, I do not see any opportunity there. If it's under 1%, then you're really going to be losing after accounting for the fees. Once it gets over 1% is when I start to perk up and realize that anything over 1%, now we're about covering the fees, being conservative. And now if it's above that, I can start to think that there is an opportunity there, but there is still the concern of how long is it going to take me to send it to the other exchange. As you guys have seen, as I've been going through this has been jumping in and out. The premium between Kraken and Coinbase has been changing every minute, going above and below each other. So just because that premium or discount is there and it's above 1%, it doesn't mean it's going to be like that for another minute or even another second. And it takes a significant amount of time to transfer between exchanges. So we are needing that premium to hold while we transfer our Bitcoin over to sell. And while we're doing that, we are probably aware that other people are very much doing the same thing. If I know that anything above a 1% premium presents an opportunity to profit, I'm not the only one that knows that. And there are other people out there with bots and sophisticated alert systems and everything like that, that they are in there. And while I'm waiting for that transfer to confirm, I know that others are doing the exact same thing. And if I'm at the end of the line, then I could be left holding a bit of a bag where the premium has disappeared. And now I'm looking at potentially selling at a loss. So that is is the risk once you do identify a spot where there is potential room to profit. Then you need to calculate the fees and understand the time that it takes to move between exchanges. So that's where this can come really in handy. Up top is the top spreads. Often the best spreads won't be for Bitcoin. And if you are comfortable in arbitraging alternative coins, then there will probably be a lot more opportunity than if you're just looking at Bitcoin. And first thing we see is the high spread is 50.9% between Bitcoin Cash and USDT. Again, this is something like here where this is just too high. This is too abnormal. There's something going on here that I just don't understand, but somebody else probably does. The cheap exchange, Huobi, there's probably something going on there, or maybe there's something going on the exchange with the huge premium. I don't know. I'm staying away from that. Here's something that I like to see. This is the bid-ask spread. So this is the difference between the bids and the asks on the order book. So this isn't between two different exchanges. So just be aware there. But this percentage, something like 1.93 between a low and a high exchange, that's something that I want to see because it's reasonable. It's not so outrageous that it tells me something's got to be going on. It tells me that there's still some room in there to profit, and there should be. I mean, there's always different people buying and selling on different exchanges. There might be one guy in an exchange that panic sells, and he does it in a big way. He has a big holding, and he market sells a ton. There's going to be a premium there, or there could be another exchange where somebody's FOMOing in and making huge market buys. If that's the case, there's going to be a premium that's not going to last for too long, but every single day, there is likely going to be some type of opportunity that will be a very small window that if you become an expert at tracking these different pairs and these different exchanges and these different coins, now we can get into, once you get some experience with trading the different ones, you might start to realize, well, wow, man, Litecoin is way faster and way cheaper to transfer. So if I see an arbitrage opportunity on Litecoin, that's maybe one I want to jump on way quicker than something else that is maybe a little bit slower or more expensive. Bitcoin Cash is very slow. The last time I tried doing anything with it, which could justify a bigger premium, which is a reason why I would want to stay away from it. So last thing to touch on here is this exchange CEX. We do see it listed here on the USD exchanges. This is one that I have experience with. I am not recommending, but I am maybe suggesting to keep an eye on it because it is one where it did have a significant premium throughout almost the entire bull run of 2017. It's CEX.io. Again, no affiliation, and I'm not recommending them. However, they are one that I'm going to be paying very close attention to because in the last bull run, they were up here. They had a 2 to 5% premium the whole time. It basically never went away. And anytime it did, it was a tremendous buying opportunity. And they are in USD, so you're not holding Tether when you sell on CEX. They did have some issues with some payment processors, and you have to do all the diligence yourself if you decide that you want to deal on an exchange like that. But they were one that I became comfortable with and that provided me with some tremendous opportunities to enter in the 2017 bull market. And that with that premium being 2% to 5%, that essentially allowed me to enter into positions and take on very, very little risk. In general, I'm looking at about a 5% stop loss. 5% stop loss for the style that I trade is usually sufficient. I'm a swing trader. I focus on the 4-hour and the daily chart, and using a 5% stop loss on average is sufficient for the way that I want to trade. So the main way that I was able to get entered into the last bull market when it looks like the price was just continually running away from me was I would buy on Coinbase, and then I would when I thought it was a good entry. I identified a stop loss that was approximately 5% away from my entry. So I bought on Coinbase. I immediately transferred the spot Bitcoin over to CEX, not in order to necessarily arbitrage that, but that's where I was going to take my stop loss. So if the price moved 5% against me, now I am even, and that allowed me to enter into positions and use a reasonable stop loss, but not really risk any capital because of the premium protecting me there. So that is potentially an opportunity, CEX. What I noticed was that the exchanges that focus primarily on the Asian markets would get the most, were most likely to get the premiums. In the bull markets, the premiums occurred on the Asian exchanges in the large majority of the time, which indicates to me that there were more people in China and Japan that were buying spot at market than there were on the American exchanges, and that was persistent, which led to that persistent premium and some incredible opportunities. So the one other thing to say is that when the volatility is low and the price is kind of moving sideways and sticking in a pretty reasonable range, we have low volatility, premiums are going to be very low because there isn't much going on. We're stuck in a range and there isn't much room for there to be a premium. But when a breakout occurs and the price really starts moving and it starts moving fast, that's when these spreads will become very pronounced, and they will be, you'll be able to capitalize them much more so than any other time, because there will be exchanges leading, there will be exchanges following, there will be high volume exchanges that will almost always lead lower volume exchanges. And if you can learn to identify these areas of breakouts and look, and then that is what tells you to start paying very close attention to these premiums, then that can be a great opportunity. And I say one last thing probably 3 times now, but just to take a look at this tokenspread.com at the top, you can set alerts up here based on price acceleration or price spread. So definitely a great website. That's tokenspread.com. Anything to add before I briefly take a look at the futures on BitMEX?
Just a question. What have been some of the, what is the range of the spreads that you have seen? When everything's going right and some of the exchanges are falling behind, how big of a premium have you seen between the exchanges? You mentioned the Asian, I guess it was Korean exchanges that were up well over 20,000, 21,000, 22,000 when Coinbase and others were hitting that, or Bitstamp was hitting 19,666. How big of those spreads have you seen?
Yeah, great question. The number that really jumps out at me and makes the hair stand up on the back of my neck is 10%. There have been a handful of times where I've seen a 10% premium on USD exchanges between one another, maybe 2 or 3 times where that's happened. And basically every time that that's happened, that has identified a major top in a local major move. So not necessarily the whole top of the whole run, but like at 5,000, when it first got up there, I remember the premiums were getting ridiculous. And then at the absolute top, they were, the premiums were just absurd. They were 10 to 15%. Nobody really could even quantify the price of Bitcoin at that time because the exchanges were so vastly different. So I always like to keep some money sitting in USD on an exchange, an amount that I'm absolutely willing to lose. that is waiting for these high spreads. If it does get above 5% and gets anywhere near that 10% level, I'm jumping on it and I'm wanting to make a big play, because that premium will last long enough generally for me to make a play, but it won't last more than like a day. And that was actually something that I was keeping a close eye on to indicate the bottom of the bear market. Seeing that wild euphoria at the top leading to tremendous premiums across different exchanges made me think that, man, this should lead to an equal and opposite reaction. And at the bottom, people should be running around with their hair on fire. People should be panic selling everywhere, and there should be tremendous premiums. And I was thinking that that's going to be one of my, basically probably my number one way to identify capitulation and a major bottom. That didn't happen at all. We didn't have any premium on any exchange at the bottom. We didn't really have any panic that I could tell. That was the main reason why I was so confident it was going to continue downwards. So long answer to your question is that once it gets over 5% on legitimate exchanges, we're talking Coinbase, Kraken, Gemini, we're over a 5% premium on those. That's a huge signal that there's something wrong with this market, that it is, very euphoric and irrational.
Excellent. That's great stuff. Okay, now I know Ugly Old Goat makes a living off of BitMEX and has for a long time. Why don't you tell us what you found in terms of arbitraging at BitMEX?
Yeah, absolutely. And now this is something that I don't have near as much experience with, very minimal, but it is something that I have thought a lot about and really focused, tracked these spreads very closely over the last 6 months or so, and have found a few ways that it can be a good indicator, but it also is a pretty standard way of arbitraging. So right here on BitMEX, we see the different contracts that are being offered for Bitcoin. The perpetual, that is basically the spot contract. And then we have 3 futures contracts. Expires June 28th, expires September 27th. This one recently opened, expires December 27th. So those are the 3 futures, and this is the spot. And using futures to arbitrage is probably as old as futures are. And that we can go through real quickly what can be done. So a normalized futures curve is otherwise referred to as contango, and that means that the futures are more expensive than the spot, and they should get more and more expensive the further and further out they go. So we see the spot 92.75, June 93.08, September 94.24, December 94.26. So the further we go out, the more expensive the price of Bitcoin is based on these futures contracts. That is very common in commodities because there is carrying cost. If you are to, let's say, own gold, and this is an ounce of gold, then you're going to have to store that for, say, the next 3 or 6 months. That's going to have a cost. It may be pretty minimal for 1 ounce. It may be significant if it's a big lump sum. So generally, the cost to carry or the cost to store is the reason why the futures are more expensive than the spot. And in general, it will be very, very close. If it's going to cost you, say, $100 to store an ounce of gold for a year, then the future that expires a year from now should be about $100 more than the perpetual. And if that is different, then there is an arbitrage opportunity in a traditional commodity market. Now, this is very, very different with Bitcoin because of the fact that it really doesn't cost much to store. There really is not much carrying cost. There's some risk associated with, you know, losing your private keys or something like that, but there really is not any carrying cost. You buy yourself a ledger for like $70, and that's it, and you can store 1,000 Bitcoin or you know 0.1. So because there is no carrying cost in Bitcoin, the futures market can present some very unique opportunities. So let's think about the easiest way that we're going to arbitrage this market right here. If you just think about what is the simplest way to take advantage of this premium, we would look at buying the spot and selling the future. Now, if you do that, you are buying low and you are selling high. So in a sense, you are capitalizing on this spread, on the difference between the price right here, and calculating that, that's a 1.75% difference. So if I buy spot and sell the future, 1 Bitcoin spot, 1 Bitcoin future, now I would expect to capitalize on 1.75% of profit based on that spread. However, we're going to have to get out of both of those contracts to be able to actually realize that profit. So you would want to be considering, do I expect this premium to decrease, or do I expect this premium to increase? If I expect this premium to decrease, then we would want to bet a little more here, maybe 1.1 Bitcoin on this and only 1 on the long, because when the premium decreases, it's generally done not by the spot catching up to the future, but it's generally done, in my experience, and I'll have to ask for Tyler's input, on the latest expiry coming back towards the spot. So if we are betting bigger on the contract that we're selling because we expect the premium to decrease, then this will come down, and that contract, that position will increase at a higher rate than this one, even if it does go down a little bit. Since we're betting bigger here, this spread should contract by this coming closer to the spot. So if we're betting bigger on this short, then we're going to be profiting on that contraction. Whereas if we're expecting the spread to increase, and we say, man, over the last year, this has been at a 2% premium or more, and now we're down at a 1.75% premium. Now I've got good reason to believe that this is going to actually expand, and that would be done by this rallying more, by this staying kind of back in here, and this continuing to come out and get more expensive. So in that case, I would want a smaller position on the short here and a slightly bigger position on the long here, because I'm expecting that premium to expand. So basing the position sizes on how you are expecting the premium to expand or contract is the best way that I understand to capitalize on this spread. And again, that's something that I have thought about and experimented with a little bit, but I have not tracked the difference in the premium for long enough for me to understand in what types of markets is the premium really expanding, and in what types is it really contracting. I'm still needing more experience of tracking these on a daily and weekly basis in different market conditions before I'm really going to be very comfortable trying to capitalize on those opportunities, because I know that there are people who are absolute experts at that, and they know this market like the back of their hand. So I want to make sure that I have a much better grasp of the different variables and how they can impact the different spreads before really putting too much money to work there. And before turning it over to Tyler to get his input, the last thing that I wanted to mention was how this can be used to spot major tops and major bottoms, very similar with the premium across different exchanges. So for anybody that is unfamiliar with Ugly Old Goat's work, definitely go check him out on Medium. I highly recommend to read all of his articles. I've read them all multiple times. He's taught a very unique approach that is completely reliant on this spread here. He calls it basis, and looks at the if the market is in contango, being normalized like right now, or if it's in backwardation. Backwardation is the other end of the spectrum when the futures become cheaper than the spot. When that happens, it can signal major market bottoms. We were in backwardation while the price was at 3,000 all the way till about 6,000. These markets were in backwardation, which meant you could buy for cheaper than the spot by buying a future. And that can be a very reliable indicator of a bottom of the market getting oversold. And then at the top, you look for extreme contango when these spreads get way out of whack. If they're always around 2 to 3%, and now all of a sudden this is up at 10%, people are foaming at the mouth. They're willing to pay a 10% premium because they're so confident it's going to keep going up. That can be a major indicator of a top. And kind of like I said, with the exchanges having huge wild premiums that were completely uncommon throughout the entire run, the same thing can be said about the futures premium. When that gets way out of line and way bigger than has been experienced throughout, that can be a big indicator that the market is overly euphoric and that a top is coming. So that is what I track these for, not only for arbitrage opportunities, but also to potentially indicate major tops and bottoms. And if you are interested in learning more about that, I highly recommend looking into Ugly Old Goat's work on Medium. So that's what I got for you there.
Excellent. That's really fascinating stuff. And by the way, just a plug for Ugly Old Goat's Workingman Cruz, which will be in September. I will be on that with him, going from Long Beach down to Ensenada. And basically, it'll just be a inexpensive way of spending a lot of time with some pros where you can sit around and talk with them. There will be a number of talks that will be gratis just for the cruise fees. It's going to be a lot of fun. I think the Baja 400 or the Baja 500 road race is either before or afterwards, and a lot of people are interested in seeing that for the first time. It's a lot of fun, or that's what I've heard. So Ugly is sponsoring that. Only 60 people are going to be able to get onto the cruise at the prices that he's got it priced at, which is very inexpensive. I think it's a 4-day cruise. So take a look at that also. Very good stuff. I am going to pull up a chart of GBTC and just give a little bit of info of something we've talked about for a very long time. And I'll give you my reasoning behind it. Let me see here. Let's
Excellent. And that'll be a whole lot of fun on that cruise. I've actually been on that cruise out of Long Beach, stopped in Catalina Island where they don't have any electricity. It's like a really neat old island, and then down onto Ensenada in Mexico. And it was the perfect sort of spring break for me and my college friends. We had a lot of fun while we were in Ensenada, and then right before we were going to get ourselves into trouble, we had to get right back onto the cruise ship. So that worked out just perfectly for us.
That sounds great. I'm sure everybody on this cruise will do the same thing, and everybody will be under control. Okay, what you're looking at now, and this is a very interesting website. Again, this is not my work. This is neotechdevs.com. www.neotechdevs.com. And they give you a lot of interesting things in terms of the GBTC spread. Right now, 31.45, showing GBTC at 1202, Bitcoin at $9,291.75. And so you just hit calculate and it shows you where it is. It's a easy way of doing it. They go into some details about what the calculation is. They say values are calculated based on, and then they give you the formula. It's updated every 5 minutes. Last update was 3 o'clock, so 15 minutes ago. Okay, so I'm using this to show, this is an hourly chart of the spreads, and it's all up here over 30%, 31%. So that's about what it's been trading with. When we go to a daily chart, you see that over the last 24 hours, basically on a daily basis, going back, we had a big jump in the premium from about the 20 level very quickly up to the 30 level plus. And you will see that over and over again. I will explain what, why, how, where. This is the weekly chart going back. And you can see from 30 down to 25, up to 30, all the way down to the 20 level. The monthly chart, you see a little more volatility, ranging up to 40% premiums and down as low as 20% premiums. Now, I've got charts that I've kept by hand that go all the way back 4.5 years from the very beginning. And I've done most of my analysis on when to buy and sell GBTC because I was so excited about what a gift this was. And it was a gift because when Grayscale put together the Bitcoin Investment Trust, which is what GBTC is the ticker for, traded OTC, the only security where you have direct exposure to Bitcoin. And it's the only way I have personally bought Bitcoin for clients or family or myself is using GBTC. But I got a bonus because I understand premiums and discounts, because I've done a lot of work in what are called closed-end funds. And we did a vlog on closed-end funds, and one of our webinars talked about it. And there are hundreds and hundreds and hundreds of closed-end funds. A mutual fund is an open-end fund, which simply means it never trades at a discount or a premium. It trades once a day at the net asset value calculated at the end of the day when all the trades have come in for all the positions they have. And you buy and sell at that price. If you buy at 10 o'clock in the morning, you get the 4 o'clock closing NAV. If you sell at 10 o'clock in the morning, you've got to wait until 4 o'clock before you know what your price is on that particular open-end mutual fund. Not true with closed-end funds. They trade just like a stock does. And because of that, they can trade at, above, or below the underlying net asset value of all of the assets that they hold in that fund. And we're not going to get into closed-end funds today. We'll do another whole vlog on it at some time. But just take a look at this one-year chart. These are premiums on the GBTC security or trust over and above the value of the Bitcoin. So when you send them $10,000 and you buy $10,000 worth of the stock, they do not have $10,000 worth of Bitcoin, although you get $10,000 worth of the stock. the amount of Bitcoin you actually have will be determined by the premium or the discount on the day and at the moment that you make the purchase. So you are automatically arbitraging between the price of Bitcoin and the value of GBTC. Now, in this simple chart, you see the premium has been as high as 70%, and it's been as low as 10%, lower than 10% on two different occasions, back in November and back in January. Now it's been rising up through the current 31% that we just saw, from 10% to 30%. I have a rule that I break sometimes when giving advice about I don't want to ever buy GBTC if it is at a premium greater than 20, right down in this level. And I basically want to think of selling it when the premium gets up to about 40, unless we're in a roaring bull market, at which I have seen on a number of occasions the premium go well above 100%. Now, just think for a second what I am saying. What Socrates was talking about is trying to scalp 1% or 1.5% or 2% on an arbitrage situation on a non-leveraged basis. And every once in a while, which is why I asked him the question, what is the extremes that you've seen on those premiums? And he said he's seen them up as high as between 5 and 10%. And every once in a while, when something crazy is going on, it could get up even higher than that at 15%. What you're looking at is being able to get 2, 3, 4, 5, 10 times that amount. And here's how it works. In a bull market, people will bid up the price of GBTC in anticipation that Bitcoin will keep going higher. In a bear market, what you tend to see is people selling GBTC because they think Bitcoin prices are going lower. And that simple equation is what drives the premium up and down. So if you study the premium, you can buy down at 10 regardless of if Bitcoin is going up or down. Because what will happen if you buy at 10 and Bitcoin doesn't do anything, it just sits, let's say, at the $6,000 level coming down in 2017 and 2018, in 2018, when the price of Bitcoin was dropping and got down to 6,000 and repeatedly couldn't get below it. Basically, it was going sideways for a long time. And a lot of people got frustrated that they own all this Bitcoin and it's not doing anything. And then finally, it did do something. It cracked and fell apart from 6,000 down to 3,000. But during periods of time when Bitcoin isn't really moving, the premium on GBTC continues to oscillate up and down. Therefore, if you buy it at 10 and you sell it at 20, in this case, buying it at 10 and selling it almost 30, you make 20% on your GBTC, even though Bitcoin hasn't moved. If it goes from 10 to 40%, you make 40% because your premium goes up from 10% to 40%. And now you step aside and you make that differential over Bitcoin. Now, that means you have to be watching Bitcoin, you've got to be watching GBTC, and you've got to be watching the premium or the discount. Yes, discount. I have seen this chart drop below 0. You want to buy GBTC whenever you see it below 10, below 5, and on those moments when there's a panic or some institution or large holder sells GBTC outright and it drives the premium down to 0. Because now you have no risk. You own the same amount of Bitcoin as you as its intrinsic value in GBTC without paying any premium. Now, there's a couple of other things having to do with slippage. There's a 2% annual fee for owning this trust, which means that over time, after 6 months, 1% is being eaten away, 0.5% over a quarter, et cetera, et cetera. But that does not take into account the movement of the premium. If you're at all good and you can buy a premium at 10% and sell it at 20%, a short time later, from November to December, in a 30-day period, the premium can go up from 10 to 30. The fact that you're paying 1/12 of 2% is insignificant. So you have to weigh all of those things, but it's a wonderful way of arbitraging the difference between a security and Bitcoin itself. And I would prefer it to buying Bitcoin because it is regulated and registered to the SEC, so you don't have any regulatory problems. Whereas with everything else you do in the crypto land, you're always wondering if something is about to happen, either with your exchange or with the movement of money or with the freezing of money or the hacking of an exchange or outright theft, on and on and on. Here, you are protected under SIPC up to $250,000 per account, joint accounts up to $500,000, et cetera, in terms of a loss due to something that happens with the underlying issuer. Okay, so that's the way all that works. This is called neotechdevs.com. It's simply a very simple way so you don't have to sit there and do the plotting yourself. They do have a formula if you want to plot it yourself. I spent 2 months plotting daily premiums going back to the beginning of GBTC, which I continue to watch just to see for patterns. And the way I think a wonderful way of calling tops and bottoms in markets is watching the premiums on GBTC. There's billions of dollars in GBTC, most of it institutional. It's the only way for people with retirement accounts to, without any fear, buying Bitcoin in an unregulated, in a regulated way, as opposed to unregulated, and not running afoul of Department of Labor or securities law with a number of IRAs that purport to be able to allow you to buy Bitcoin directly. There is a way to do that, but 95% of the sponsors don't use that one legal way of doing it. It's very complex. And for those that want to know more about that, we will do a show on that at some point. Okay, enough of all of that. We have gone a full hour talking about. Yeah, please.
Got some questions for you if you want to leave that up or pull up that other chart real quickly.
There you go.
So quick question that I'm trying to understand. So back in November, we see it down at 10, slightly below, and then it rallies up to 30 or so in December. So a 20% increase in about a month. So let's say that we bought that bottom in November when it was right below 10, and
Yeah,
then it runs up to 30.
right,
But in that time, the price of Bitcoin decreases 20%. Are
right.
we now breaking even? Are we still making money? Or what's going on there?
You have made 20% on the premium. You have lost 20% on Bitcoin, so you're net zero. If you were
Okay.
only in Bitcoin, you would have lost 20%. The flip side of that is in December, if you had bought this at 30 and Bitcoin drops 20%, and the premium drops 20%, you are going to lose 20% on your premium and 20% on your Bitcoin. So this is an arbitrage in which what you are attempting to do is you're attempting to get in and hold the GBTC until the Bitcoin falls in line, meaning the Bitcoin begins to recover from that 20% drop. You don't sell GBTC, you hang on to it. And then when the premium gets back up, probably because Bitcoin is going up, you are going to make it on both sides of that equation. Now, this is something that if any of you were following Tone Vays's trade that lasted a long time on his GBTC purchase, he got into it because the premium was right. And if he hadn't been flying around and traveling and doing other things, he would have been able to lock in that premium when Bitcoin prices fell and then came back to where they were, because he would have been able to lock it in a very short period of time. It took him 3 months of holding on to that GBTC before Bitcoin responded to the upside. He was able to make money on the Bitcoin side of the trade and on his original GBTC side, because during that period of time, the premium began to increase. So that's a great question. And that's the way you have to play this.
Excellent. And we've got a couple other good questions. Do you have time to
Of course.
cover? All right. And before I get into that, that just makes me think back in November when that fell below 10, buying GBTC and then selling spot Bitcoin, if you had any, that could be a really good way to protect yourself from the downside, in the sense that if you sell the Bitcoin and it keeps going down, now you can buy it back cheaper. And if it goes up, now you're going to be capitalizing on the premium and the appreciation, but not costing yourself anything, because you're not actually in a short, you're just selling spot. So something maybe to consider there. And pulling up a question. So the first one I'll try to answer, and next two will be for you. If my answer is insufficient, please let me know. So Alexei Kulev asks, in the last webcast, nope, wrong one. This is a question from live chat. It says, and then when you make money with arbitrage, buying and selling, but isn't it the case that Americans then have a taxable event? So that was a question that hopefully I can answer real quickly. So let's say that I've identified a scenario where I think I can make a 1% scalp on an arbitrage opportunity by buying on Coinbase and selling on Kraken. So what I do is I get $10,000 set up, I buy, I send it over, everything works out great. And I capitalize on the 1% exactly how I wanted. Everything works out perfect, which it doesn't usually. So we're just saying this time it does. I saw 1% and I went for it and I got it. So now my $10,000 is $10,100. And yes, I'm going to have to pay taxes on those gains. I made $100, and that's clearly short-term capital gains. So say something like 45, 50%. I'm not a tax advisor. I'm just going through a brief example. So let's say I pay 50% taxes on that. That's $50 that I send to the IRS. Now I've got $10,050. So I'm up. I'm up 0.5% on my money after paying taxes. If I saw that opportunity, I just decided that I'm going to avoid this, I'm going to stay away because this would be a taxable event. Well, now I've got $10,000. I didn't take on the risk of executing that trade, but I still have less money than I would have if I would have executed the arbitrage and paid my taxes in full. So that's how I think about it, and why I never think that taxes are a reason not to enter a position or not to take profit. So as long as there's nothing else to say there, I will move on to the next question.
Well, let me just jump in for a second.
Yep.
Remember, you only pay taxes at the end of the year, and it's the sum, the net of all your short-term gains and all your short-term losses, all your long-term gains and all your long-term losses. What that means is, unless you only do one trade and it's a gain and you don't do anything else for the rest of the year, in the case that Socrates just mentioned, you're going to pay anywhere from a $35 to a $50 tax on a $100 gain. But that's not the way the real world works. If you're trading, you're going to have 150 trades that worked, 150 trades that didn't work. And depending on how much you made through money management by letting your gains run and your losses you stop, you have a net gain out of an equal number of trades. Well, that doesn't mean you have to pay taxes on those gains, because you should be also trading long term, meaning a year or more, with most of your money, your investment money. And in that investment money, the 60% that I talk about in indexes, 25% in sectors, and only 15% for speculation, it's in the speculative category where you're doing short-term trades. You're jumping in and out, in and out, in and out, in and out. On the sector and the longer-term stuff, you're carrying gains and losses from last year, the year before, the year before. And what happens is you can use those losses against gains to negate them out. And that's part of money management. We'll try to do a whole show on that. Your CPA can walk you through it. Any trader or any investor can walk you through it. It doesn't happen in the crypto world because you're very limited to basically buying and holding, in which case you are never going to pay taxes on it. Maybe your estate will, or your estates will someday. Or you are short-term, getting in and out, in and out, in and out, in and out, running up all kinds of things on exchanges that some of them are KYC, some of them give your information away, some of them are illegal and unregulated, and you're going to run into problems anyway. Or you take a long-term trading strategy in which you hold things for long enough periods of time that you can establish gains and losses in some semblance of order where you can do tax planning around it. So go ahead, Socrates.
Excellent. Thank you for adding there. And I'll have one more question for you. This will be a good one to end it on. And this is the one from Alexei Kulev. And it asks, in the last webcast, Tyler said he is selling Bitcoin. Why is he selling if the picture is very bullish? Is he expecting to re-enter at a much lower price in the near future?
Great question. And thank you for bringing it up, because there's a lot of people on Twitter that don't get it. Basically, here's what happened. We bought down at 3,000 in 2017, and we sold around 17,500 using GBTC. I picked up another 75 to 100% on top of that because of the premium. I would buy when the premium was low, and I would sell it off regardless of the direction of Bitcoin. Not all of it, but enough to lock in the premium spreads. After that, I didn't do any trading in GBTC or Bitcoin until prices dropped from the $19,000 level all the way down to 3,100. I thought it was going to go lower. I was wrong. This time around, I think I will still be proven right, but just not right now. So right now, what I did is I bought a little at 6,200, 6,400, 6,500, up to 6,800, an average of $6,500. We put 20% of X in, where X was the amount that a client had, or I had, or somebody had. And that's what I gave advice to all of our consulting clients and made public as I was doing it on vlogs and on Twitter. So those are the only trades I've ever done in Bitcoin or something related to Bitcoin GBTC. I've never bought or sold any other crypto. So we had a buy at 3,000, a sell at 17,500, nothing down to the 6,000 level, at which point I put in 20% of the total amount I wanted in, because I still thought lower prices could come. But I loved the action on an intermediate term basis of Bitcoin and the other cryptos. I do watch all the other crypto prices. I do look at the spreads, and I have a strong working knowledge of what leads what in short, intermediate, and long-term moves in the crypto market. And I liked what I saw when we broke through 6,000. And I liked what I saw when we ran up to 8,200. After we broke through 6,000, I did not buy anything. But at 8,200, I liked the idea that it had come too far too fast. So I put in buy orders at those levels I mentioned, starting at 6,800 on the way down, not after it was at 8,200, but on the way down. If it fell to 6,800, I wanted to buy some. So I basically told people, and did it for individual clients, to buy at 6,800, 1/3 of that 20% position. And at 6,600, 1/3 more. And at the 6,400, 1/3 more. So that we would get the full 100% between 64 and 68, or an average of 6,600. Depending on which clients did it, which consulting clients took my advice. Some did it exactly that way. Some did not. Some missed the 64. Some were able to buy at 62 on that drop down to 62.20. They bought a little bit above 62. So everybody's different. Everybody makes their own decisions. But in general, we were in between 65 and 6,600 with 20% of X. If X was $1 million, that means people put $200,000 in at that level. If they had $10,000 X, that's how much they were willing to put into Bitcoin, then they ended up with $2,000 in Bitcoin at those three levels of averaging about 6,500. So when you said that I'm talking about selling, what happened was we ran up from 6,500 to $8,800, got very close to 9,000. I decided we would take half of that 20% that we owned at 6,500 and sell it at 8,800, and that's what we did. We remained in the other 10%. On $1 million, we had 200,000. We took profits of from 6,500 to 8,800 on half of that $200,000. We have continued to hold, and still do as of this afternoon, the other 10% long from the $6,500 level. Now, what Alexa is talking about is I have been talking on yesterday's vlog and the vlog before and the vlog before, that I'm looking for an exit somewhere in the $9,000 to $10,000 range. Well, we've gotten that. We've been at 9,000, 9,100, 9,200, 9,300, and 9,400 on a couple of occasions. I have chosen not to sell those other 10%, that other 10%. Why? It's too strong. As Socrates has been saying very correctly, these short-term moves and more of the intermediate and longer-term signals that I look at, other than my hyperwave theory, but Consencio, Kopic curve, ADX, Bollinger Bands, various moving averages, a lot of different things are refusing to look overbought to me. Therefore, I continue to hold, because maybe this will go to 95, 96, 97. Maybe it will work its way through 10,000, 10,100, 11,000, 11,100. I will not be a seller on the 10% we have. I will turn into a buyer at those levels. Because as we work our way through the overhead resistance, and the longer it takes, we are turning from an intermediate term bull market into what could be the beginning of a long-term bull market. And I want to be fully in it long before we get anywhere near the old highs. So that's the long explanation of where we are right today and what my thinking is.
Excellent. Great answer, and I certainly appreciate that input. What I want to reiterate that hopefully people are hearing is that Tyler is being flexible, and he's paying very close attention, and he's not just looking at an exact price level. He's looking at how does the price get there? Is it getting there and remaining strong, or is it pulling back and looking scared? And then also he is considering about buying at higher prices, at significantly higher prices than we're seeing right now. And to the layman or somebody who is new to the space, they have a really hard time wrapping their head around that. Many people will say, well, if you didn't buy at 3,000 and 4,000, well, why in the world are you buying all the way up here? And that is really missing some very important concepts in regards to what it takes to actually consistently beat the markets. And if that's what you're thinking is, why wouldn't Tyler buy here? If he's willing at buying at 11,000, why doesn't he buy here and get 20% more Bitcoin? If that's what you're thinking, then really ask yourself, why would somebody wait to buy after breaking through resistance? Why would somebody be willing to pay a premium after price has proven its ability to maintain certain price levels? Think about all of the different factors that are going on, and don't be like most thinking that, well, I should have bought at 6K and I should have bought at 4K, and now I don't know what to do. I don't want to buy all the way up here. That's the wrong way to think about it. The trend is your friend. And as long as the trend is in a bullish posture, you want to be looking for areas to buy. And the longer we continue in a bullish posture, the stronger the trend becomes. And I fully agree with Tyler. We're not in a long-term trend just yet. This is only an intermediate term trend. And the longer that we maintain this short and intermediate bullish movement, we will be entering into a long-term bullish market, and betting with the short-term, the medium, and the long-term trend is the best way to make money and protect risk. And sometimes the only way to do that is to wait for significantly higher prices than are currently available right now. So that is my 2 cents, and I think that's a good place to wrap it up. This was a great show. We might have some more to follow up with later, but I think we covered everything that we wanted to, went over 3 ways to capitalize on the spreads in crypto. We looked at different exchanges, same coin and 2 different exchanges. We looked at the futures market on BitMEX and buying spot and selling futures. And then we also looked at GBTC and the premiums that it tends to range in between and how to capitalize on that. So this was a great show, Tyler. I sure appreciate you having me on, and I will wish you plenty of fish to catch on your rest of your trip in Michigan.
Great, we're killing it. Yeah, thank you very much, Socrates. Some great stuff, and thank you, everybody. We'll be seeing you again tomorrow.
All right, sounds good.